Good morning, good afternoon, everyone. Thank you for joining us for another edition of PE Forum. Today, we have the extreme pleasure of welcoming Charles Dallara, advisory partner of Partners Group and chairman of Partners Group Board of Directors USA. He is former Institute of International Finance CEO and director at large at the National Bureau of Economic Research. Charles, thank you so much for joining us today.
I'm glad to be with you and glad to be part of the Private Equity Forum.
Thank you so much. So you just launched your latest book, which is Euroshock, and it's the inside story of the restructuring of Greece's debt in 2012, which is the largest restructuring in history. And you go over how the Eurozone was stabilized and Greece was saved from exit and how we avoided the European economic calamity, let's say. And so I cannot help but link, the timing of your book with a world where we see incredible levels of debt never seen before. And so my first question would be, have we learned anything from the lesson of the Greek experience?
Well, I think you asked the toughest question up front. So I was hoping you'd save the tough questions till the end. But look, I think, having gone through that painful exercise to restructure Greece's debt and to wipe out the largest amount of debt that's ever been destroyed, you might say, the largest amount of claims by private creditors. On one morning, we pushed the button and eliminated $107 billion worth of debt, which even for the Middle East region is a big number, right?
Absolutely.
Even for the world's largest oil producers is a big number. And looking back upon it, it is ironic that on the one hand, the Greek economy has turned around, and I can come back to that story now. It was just recognized as the country of the year by the Economist magazine, and rightfully so, because they have really addressed a lot of their economic problems, and they're steering a very sound course of economic reform and rehabilitation, you might say. On the other hand, as you point out, global levels of debt have risen dramatically over the past 15 years. It seems as if trying to climb out of the global financial crisis led initially to large spurts in debt accumulation, both sovereign and corporate. But there has not been a correction of that trend. And that is quite worrisome because if you look at debt levels from China, where the issues are largely revolving around corporate debt, to the United States and many of the countries in Europe, where the issues largely revolve around sovereign debt, you have to be a bit concerned about this massive accumulation of debt and the ability of countries to service it with ease, and also the risk that one or another country may find itself like Greece did 12 years ago in a period of tremendous market pressure and a crisis brought on by overborrowing.
So just to go back easy then, before jumping back again into the tough questions, and your experience during this Greek crisis, we often forget that it's men and women negotiating, fighting, and being tired. And so I was wondering, during this experience, how many sleepless nights, and when you were facing politicians, what made the deal possible at the end? What made it happen? And what could have gone wrong, basically?
Well, those are three related, but also fairly tough questions. You're a tough interrogator. But first of all, many sleepless nights. For the better part of a year, these negotiations were around the clock. And traveling constantly to try to be at the right place at the right time, circulating mostly among Brussels, Paris, and Athens. Those were the key nodes of negotiation for us, although we did negotiate in other locations. But it was an extremely pressure-packed process because it was not just the Greek debt that was at stake here. It was the stability of the entire Eurozone and the ability to preserve the euro. The euro had been a fairly new creation, created only 15 or so years ahead of the crisis. And if Greece had been pushed out of the Eurozone, I'm convinced that the entire Eurozone would have fractured. We would be living in a totally different world today. And so there was a lot at stake. And it also happened that this crisis of stability of the future of the euro itself was also really creating a cloud over the economic recovery of Europe from the global financial crisis. In fact, in some ways, the euro crisis is part of the aftershock of the global financial crisis. So you had the global financial crisis, the euro crisis, and embedded in that at the very center of the euro crisis was Greece. But I think it's important to recognize that although we were focusing in my negotiations on the Greek debt, that the Greek instability was surrounded by other countries that were also under serious market pressure, notably among them Italy, Portugal, Spain, and Ireland. So you had 5 countries experiencing this crisis. We ended up having to work tirelessly with our own creditor group, because I was representing, along with my co-chairman and I call him my co-conspirator in a good sense of the word, Jean Lemierre, who was at the time senior advisor to the chairman of BNP Paribas. Now he is the chairman of BNP Paribas. We had to work constantly with our own creditor base, the group of banks, insurance companies, and pension funds. And the dialogue needed to be almost continuous with them to make sure that we had the right position to represent them. At the same time, our negotiating partners on the other side of the table were various European officials, some of whom really did not want to be in the room with us. And we had this paradoxical situation where the chief negotiator with us on the other side of the table was actually the deputy finance minister of Italy, representing the entire Eurozone, but also deeply concerned about the stability of his own country. So this made the negotiations exceptionally difficult and at times very, very awkward. At the end of the day, you have to constantly work to find common ground. And that's how we came together, because even though there were threats coming out of Northern Europe, in particular out of Germany, but also the Netherlands, Finland, and other countries, that they threatened that, look, Greece should be out of the Eurozone and we'd be better off without them. But many of us had the instinct that I think has proven correct, that this could have been a disaster for Greece and for the Eurozone. In the end of the day, we found serious leaders of Europe, including, in particular, Chancellor Merkel, but also President Sarkozy, who, notwithstanding their temptation to deal harshly with bankers and at times to deal harshly with Greece, we nevertheless were able to work continuously to find common ground. It was also complicated, I would say, though, by the inability of the International Monetary Fund to find a sound approach toward the Greek economy during this period. They kept asking for more and more fiscal austerity, when hindsight has proven, and many of us knew that at the time, that this was not the answer. When an economy is collapsing, you don't ask for further tax increases and further belt tightening, but that was the recipe the IMF prescribed. In the end of the day, we managed to get through this, and part of the solution rested around the willingness of bankers to put the future of Europe ahead of the future of their own banks. And I don't mean to say that they were complete egalitarian, but I do mean to say that they recognize that even though they may take a serious hit with their losses to Greece, that was probably a necessary price to pay to preserve the stability of the Eurozone and not precipitate an even more severe crisis that could lead to a true recession and depression in Europe.
And so if we move on to our world today, and we look at the sovereign debt to start, I mean, and we look at the US, that's I think the debt has reached 124% of the GDP. The European countries that you mentioned, and we can add it to France to that list, also have a high level of debt. Are we in the process of facing this time not a Euroshock but a global shock that will maybe put an end to globalization or to the financial system that we have today? Or in other words, are we in a very precarious and dangerous situation in your view?
Well, I don't believe a global shock because of sovereign debt is imminent, but I do think that unless we and the political leaders of the United States and Europe in particular recognize the need to bring about more fiscal discipline, that shock could actually happen someday, and it may not be that distant into the future. As you point out, U.S. debt to GDP is now over 120%. That is double, slightly more than double what it was 20 years ago. And that's a phenomenal deterioration in our debt to GDP ratio. Now, it is true that we still have in the United States a dynamic economy, and everyone is very excited about the potential of further dynamism and productivity as a result of AI. But on the one hand, you have those positive trends of innovation and new technology enabling us to take advantage of new application of digitalization and technology through AI. On the other hand, you have this looming cloud which is growing. Let's be serious about this. This cloud over the U.S. economy's ability to service its debt and to protect its own financial integrity is growing. I don't forecast particularly a Greek analogous situation for the United States. We are still the most dynamic economy in the world and the reserve currency. But it's unfortunate that our politicians seem to be taking this for granted today on both sides of the aisle. And I'm not particularly critical of either the Republicans or the Democrats, but I will say that the spending that has unfolded in the last few years is very, very worrisome. I remember a time as a young man at the U.S. Treasury Department in the late 1970s, when the dollar was under pressure and the credibility of our fiscal position was declining steadily. This were the period when we were facing high inflation, a weak dollar, weak confidence in the outlook for the U.S. economy, a growing fiscal and current account, that is external imbalance. This is the period 78 to 79 when Volcker had to step in and rein in inflation. So I lived through a period where the U.S. had so few foreign currency reserves that we actually had to borrow off market, Swiss franc and German mark at the time, in order to boost our coffers of foreign currencies so that we could buy the dollar when we needed to and support it in the foreign exchange markets. That was an ignominious moment for the United States, and I don't want to see us get there again. We are not alone, and I do worry a good bit about the steady accumulation of debt, not as dramatic, but still worrisome in countries like France and Italy and others. I think that we cannot continue to kick this can down the road forever, because rating agencies will react. Markets then will react to the moves of rating agencies. And suddenly it could become more difficult to finance these deficits. And we know that markets can be, in the short run, quite erratic and quite volatile. Look, markets are a wonderful thing over the medium and long run because they equilibrate supply and demand, even for currencies and financial market instruments. But in the short run, as Greece learned, and as many other debtors have learned, they can provide a lot of pressure that, if unanticipated and poorly managed, can really create havoc in the domestic economies themselves. So this is I think, a time for recognition and a time to absorb some of the lessons to be learned. One of the gentlemen who was kind enough to write a blurb on my book, Euroshock, Nouriel Roubini, who's a very well-known global economist, said in his blurb that the lessons learned from Greece should be carefully studied by the American authorities. And I can only underscore what he had to say.
Yes, we agree on that point. If we look at, I mean, the risks on the, you mentioned that, there's the economy, U.S. economy is still very dynamic. It's the most dynamic, but there's this cloud, that is becoming worrisome. The GCC economies are, with their currencies that is pegged to the dollar, very linked with the US and the dollar. How would the crisis affect them in your view? Would they be dragged into it, and what would be a worst case scenario in your view?
Well, I think they would be affected, but I think that their policy, because virtually all these currencies except the Kuwaiti dinar are pegged to the dollar, and I think Kuwait pegs it to a basket. But you're absolutely right. They would be affected. But I think that they would be able to manage the downside of this very capably. What they have to anticipate, however, is that they may live through a period of a weak dollar. And this could certainly complicate revenues that are dollar-based, complicate their own fiscal position. I think, though, that the pegging approach is unlikely to change. And I think that they would most likely, unless things became extraordinarily volatile, hold on to the peg and preserve the framework of their policy. So I am not deeply concerned, but I think the second and third order effects are something to think about. If the dollar comes under pressure, and if the U.S. economy comes under a big cloud where it undermines our growth and our productivity because we are perceived as having mismanaged our fiscal accounts, then of course we know how closely tied the U.S. is to, how closely tied the Middle East and the oil producers are to the American economy. And, we would also have to ask in a moment of stress on the U.S. economy, what about the Chinese economy? I just returned from a trip to China, and they're struggling with a serious set of economic challenges right now, in particular, a real estate crisis that has not lessened over the course of the last 2 years. If anything, it has stabilized at a difficult level now, where the prices of real estate, especially residential real estate, are very weak, and the functioning of the market has become more and more disrupted. Solutions will need to be found to that. But if a crisis were to erupt, which focused on unmanageable levels of real estate and corporate debt in China, this could add to the global gloom. We know that, yes, we are no longer in this period of perfect globalization, right? We've moved away from that. Personally, I do not believe that what we are living through today is an era so much of deglobalization as it is adapting globalization to the new geopolitical realities. When I was in Asia over the last 2 weeks, I noticed how many companies, and not just American and European, but Japanese, Korean, and even Chinese companies are diversifying their production facilities around Southeast Asia. $145 billion of outbound investment from China last year into the rest of Asia. That's a remarkable new trend that we see. These adaptations to the new geopolitical strains are going to, I think, continue to preserve a serious element of globalization. But we are living through a period where these geopolitical tensions can add to the cost of trade and add to inefficiencies in the overall relations among countries, because the more we see tariffs raised, the more we see restrictions on trade and investment, the more we undermine the efficiency gains of globalization. And so I do worry that if we're in a period of losing some of our edge at productivity and efficiency because of this new adaptation, this new form of globalization, that if a sovereign debt crisis comes on top of that, we had better duck.
So now you're the one who's being tough on us. It was very optimistic at the beginning. Now it's kind of reversed. So now
Maybe
we're
so.
but
Maybe
if
so.
we go,
You told me into it.
yeah, well, lesson learned. If China was actually, thank you for pointing out, because China was actually my follow up question, and this world that is changing in precisely. You mentioned, countries or politicians, they care about the growth of their country. They don't want to, hamper that. So what would be the tools that they have in their hands in order to, you had talked a year ago about the soft landing and moving forward. How do we soft land the level of debt? How do we solve that? I mean,
well, I
today,
think we have to bring back discipline to managing our fiscal accounts. That's the bottom line. It takes a willingness to acknowledge that there are trade-offs in this world. You can't spend money for everything, no matter whether you think it's a very legitimate regional, local, social, or national objective. And you also have to recognize that we need to find a balance between revenue raising and spending. And it seems to me that the process of resolving those competing interests has broken down somewhat in America and in other countries. And we are living in an era of growing populism where people like to hear that that politicians are going to do something for them. Never mind that in the end, the government may not be able to afford it. Certainly, this is one of the lessons that needs to be learned from the Greek disaster, which befell Greece a little over a decade ago, that Greece went through endless decades of clientelism, government spending when it didn't need to take place, inefficient structures and regulation, excess regulation over its economy, unnecessary layers of administrative requirements, and to be honest with you, poor management of government services for many years, and the chickens all came home to roost when the markets woke up to an enormous fiscal deficit. So what precipitated the crisis in Greece? It was recognition in the fall of 2009, when a new government came in, that, our fiscal deficit is not 5 or 6%. We think it's closer to 8%. Within 2 weeks, they revised that upward to 11%. And within another few weeks, they revised that to 14%. The markets were shocked. Now, I don't expect any such revision to go on for current, in terms of the current estimates and data around fiscal imbalances. But I do think that we need to move into an era of responsible political leadership, which recognizes that there are limits on how far we can push the government spending process, how far we can go in building and accumulating debt. And if politicians want to wait on the markets to kick them in the rear end, it's going to be a more painful corrective process than if politicians exercise a little bit of foresight and say, let's get ahead of this and start gradually reconciling our ability to fund deficits with our overall spending levels. And this process really does need to begin to take hold in the next few years. Otherwise, I fear that as we move toward the end of this decade, the risk of a serious fiscal crisis by one of the leading economies of the world begins to grow.
Well, I hope they listen to your guidance and your views. I want to move on to the second part of our discussion, which revolves around private equity, and everything you mentioned obviously affects private equity firms, but the last period of time we've had an environment of high interest rate. It seems that things might change in the future, high inflation, and we're sort of in a situation where there's a status quo with high level of dry powder and at the same time a delay in exit. How do you see this playing out?
Well, I do see you're absolutely right, Khaled, to focus in on this this slowdown in the exit process, slowdown in M&A activity in the private equity industry, and the growth of dry powder. Firms like ours at Partners Group, and we're one of the leading global firms. We're the largest private equity firm headquartered in Europe. Firms like ours have gone through a period where the sharp increase in interest rates has slowed the momentum considerably of the deal flow, because both buyers and sellers were waiting to see interest rates stabilize and then begin to decline before engaging in renewed deal flow. That was not so much in the infrastructure world, which is an important part of our private equity platform, I should say, important part of our private markets platform. Firms like ours, and there are many others, are not only invested in private equity, but private infrastructure, private debt, and private real estate. And each of those segments has a different dynamic to it. So the dry powder and slowdown in exits has been more focused on the private equity world than the infrastructure world, which in certain respects has continued to move forward because in part of the shift to a new energy paradigm, which we're all experiencing and living through, giving opportunities for new investment and deal flow in areas like renewable energy. But coming back to the PE world, I believe we are approaching a period as we move into the middle of 2024, when we are going to see a pickup in M&A activity, a pickup in deal flow in the private equity world, because LPs, the ultimate investors in our products, the pension funds, the sovereign wealth funds, the private wealth, the insurance firms, they do want to see some exits. They want to see some funds coming out of these investments. And one of the trends we're seeing is that, of course, firms may not want to fully exit a product if it's continuing to perform well, notwithstanding the uncertainty they may not want to fully exit the product, notwithstanding the continued uncertainty on interest rates. So they may have a partial exit. And this is becoming part of the solution that the private equity firms, including Partners Group, finds. I do believe, though, that we're approaching a point as we come into the middle of the year where the Federal Reserve and other central banks are going to begin to cut rates. And I would be very surprised, Khaled, if this did not stimulate, incentivate, and catalyze a renewed deal flow in the private equity industry. I think the PE industry is poised for that. It's not in our interest to sit on a lot of dry powder for that long. We need to put this money to work for our clients. They expect double-digit returns from us, and you can't get those double-digit returns if you have huge accumulations of dry powder.
Without exit, absolutely. And so there's this also another trend that we're noticing in private equity, which is the consolidation of private equity firms, and we're seeing larger groups and also links moving forward with insurance. How do you perceive this upcoming trend?
Well, here again, I think you're on the mark. I think you stay quite well attuned to the trends in private equity. We do see a trend in consolidation coming, particularly as some of the larger asset managers who are not just private equity, but who deal heavily in liquid products as well, as they try to take advantage of the strength and the performance of the private equity industry. So it's not just consolidation of the private equity industry, it's part of the broad consolidation of the asset management industry. And I think that's an important distinction which analysts and observers and participants in the industry need to recognize. Some of the larger houses are buying into private equity firms because they see the dramatic performance and they see the broad trends are beginning to position private equity in the center of the global asset management universe. 20 years ago, everyone referred to private equity as just a niche part of the alternative investment world. We're no longer the alternative. We are becoming the center of global investment activities as IPOs into public markets decline as the number of public listings decline relative to private-owned enterprises. Why is that? Part of that is that it's become clear that the model that many of us follow in the private equity world does a better job of aligning management, board, and shareholders than does the public market world. And I know I've served on boards in both the private equity and the public market world. And I think the ability to align the interest of management, board, and shareholders is a key to the kind of entrepreneurial investing which we do at Partners Group and which other investors in the private world do, that can deliver these long-term averages which are clearly above double digit. And you know, in the public equity world, you'll see one year where the public equity markets can expand at 24%, and the next year they're down 5%. You don't see much of that. We're not completely immune from the mood swings of the public markets, but we are able to sustain the performance over a period of time. And all of this is underpinning this desire for large asset managers to acquire private equity firms and also to consolidate the private equity industry. The world has seen a lot of nationally centered private equity firms over the last 3 decades, you know, and I think they will be vulnerable to acquisition. The one thing I would say, though, as a note of caution, is that culture matters, and it's critical that firms which do engage in acquisition of PE firms understand that each firm has its own relatively unique culture. We pride ourselves at Partners Group in a very entrepreneurial governance model. We pride ourselves on having a relative value framework which enables us to source deals and to manage companies and to generate value creation in our own cultural environment. And therefore, I think that the blending of and combination and consolidation of private equity firms will likely be successful only when the authorities and the shareholders responsible for these understand the challenges of blending cultures between and among different PE firms.
Very, very, very interesting. And this consolidation, do you see it as increasing or reducing risks generally for investors?
That's a good question. I'm tempted to say I need to think about that and call you tomorrow, but I won't tell you that.
Please do.
I think it does have the potential to reduce risk because it enables firms perhaps to more broadly diversify their asset holdings, but that depends in large part on the case-by-case nature of the consolidation approach. I think it's hard to generalize that the consolidation itself is necessarily risk-reducing. I think that firms like ours, and there are others, pride themselves on having a very global, diversified portfolio because we know at any point in time that our exposure needs to be diversified, not just geographically, but by industry, by sector, by currency. Diversification is so key to managing through the endless and inevitable ups and downs of investing in a global economy. And so one of the reasons why we have 20 offices scattered around the world, one of the reasons why we diversify our investments, they're thematically driven, for example, around healthcare, for example, or around technology innovation. But they're also driven with a keen eye toward diversification of risk, because I believe that we live in a world where we tend not to fully understand the dynamics of risk management. It's just not market risk or just not credit risk that we have to be concerned about. We have to be concerned about the overall macroeconomic and systemic risk. And risk management in today's world, I can assure you, is a challenging job, and we need to be very mindful of how complex it is. You know, just simple things like hedging policies. need to take into account all of these risks in order to ensure that the investor's assets are well protected.
Charles, my final question, because you mentioned absolutely you're a global firm and you see the world many times over throughout a year. Do you feel that something has changed today? Do you feel that on a trade geopolitical level, indeed, the world is becoming more divided, whether it's north, south, east, west? Do you feel that it's there's a change, fundamental change happening? If we look at trade numbers, some regions today are mainly trading with China versus the West, I call it the Europe and the US 15 or 20 years ago. Do you feel this day to day when you travel and you do business globally?
Well, I do feel that the world is changing. And I think that the way I would characterize this change is that it's having to adapt. The world of investment and trade is having to adapt to a level of geopolitical complexity that we haven't seen in decades. We haven't ever seen it since the globalization of financial markets. Globalization of financial markets really started in the 1960s when the United States, well-intended but mistakenly, decided to introduce what was called an interest equalization tax to keep U.S. investors from investing in foreign currencies. The byproduct of that was the creation of the euro market. And this was at a time, of course, when a lot of countries in the Middle East were benefiting from strong surges in their revenues because of eventually the oil embargo. The price of oil increased significantly. We've gone through phases here, but we've not been in any geopolitical environment since the 60s, since financial markets were globalized, which has introduced so many different layers of complexity to investment and trading decisions. I don't believe, as I said earlier, that we are reversing globalization, but I believe we have to understand and study and analyze how these geopolitical risks could impact investment portfolios. We are doing that at the time when we still are focused on finding the right companies, the right sectors, and the right products to invest in. And we source our deals, our investment opportunities, after studying the performance of privately owned firms and sometimes publicly owned firms, which we want to take private. We invest in those after years, sometimes 3, 4, 5, 6 years of analyzing their performance. And so we know often exactly what we're getting into in terms of a company's performance within a sector, its ability to innovate, what would be the value creation model when we buy it. Now we do have to spend a bit more time with another layer of analysis over that. How do we take account of geopolitical risk? And I think that's an important element of decision making now that did not challenge the PE world during the last 30 years, and really in some ways has never challenged the PE world, because this is a world, as you know, that has really developed in the last 40 to 50 years. The PE business in itself didn't exist before the 70s. Of course, there was always merchant banking, which was in some ways a precursor to the PE world. But we are having to spend more time on this, and I think it's inevitable. But we will never be driven by geopolitical goals ourselves. That's not who we are as a firm. We're an investor, and we look for the right places to invest. But we do need to understand those geopolitical risks. At the same time, we certainly yearn for a world where geopolitical risks do lessen somewhat. And here I will try to end on a fairly positive note. I think that the two largest giants in the room, the largest elephants in some ways, US and China, are making an effort now to strengthen their dialogue and lessen geopolitical tensions, because I think they realize that maintaining an extremely high level of geopolitical tensions is not really good for anyone.
Agreed. Well, thank you for I opened on a pessimistic note, you closed it on an optimistic note. This is why you're the investor. So thank you so much for your time. We really appreciate it, and hopefully we'll be able to host you soon again. Thank you so much.
It's a pleasure to be with you, Khaled. Thank you very much.
Thank you.